Picture this. A company's lead expert books a trip to a professional conference through Booking.com, pays with a personal card, and upon returning, submits a stack of receipts to the finance department, only to wait ages for reimbursement. Does this happen often? Absolutely. Is this as good as it gets? Definitely not. Let's explore 4 better ways to handle corporate travel payments. Here's a snapshot of the current state of corporate travel management. Nearly 2/3 of employees at mid-market companies buy flights and hotels for work trips on consumer booking platforms. 1 in 4 business travelers charges expenses for large purposes to their personal card, and the same number report losing receipts. No wonder nearly 1/3 experience delays in getting repaid. Meanwhile, travel managers often struggle to address these and other ongoing challenges.
Recent survey that BCD did from our traveller program portfolio, there's actually 52% of travel managers who actually don't know where to start or how to effectively manage travel and payments.
Miriam Foy is the sales director at BCD Travel, a global travel management company.
So on the efficiency side, many programs have manual receipts, paper receipt systems, and fragmented systems. So what I mean by fragmented systems, they have one for travel, one for expense, and one to manage their approval workflows, and just a lack of automation in general when it comes to expense. So there's no receipt scanning, there's no policy enforcements, and no automatically generated reporting.
Manual processes, lack of centralized control, and the use of personal credit cards not only lead to reimbursement delays, also create an administrative burden for finance teams who struggle with limited visibility into companies' spending.
The business will have trouble forecasting what the spend is for travel until they actually receive those reports that are sent in by the individual, and so that could lead to higher instances of fraud, right? Because those individuals may be submitting something that was not indeed a corporate expense or should not have been categorized as a corporate expense.
Al Innes is the Vice President of Business Development at Nuvei, a financial technology company.
If you think from the CFO's seat or treasury or anybody who needs to forecast what the spend is going to be on travel that can affect the performance of a company, not having that visibility can be pretty problematic in some cases, where if you have a large organization with people in the field who are traveling regularly, it can be material.
The solution to this travel payment puzzle is a centralized approach. This means combining 3 main components: an online booking tool, or OBT, a clear travel policy, and an expense management system to track all trip-related expenses. But to really make it work, there must be a 4th piece: a comprehensive payment solution, or a mix of them. What payment options are most common for managed travel?
Firstly is corporate card. So that topped our list at 84%. And then there was direct billing, which is more of a central card solution, was at 71%. And the third one, which I'll touch on, is invoice at 41%. So no card solution at all. And the 4th one, which sits currently at 38% usage, but certainly on the rise, is virtual cards.
Credit cards dominate corporate travel in Europe and the US since they're convenient, secure, and widely accepted. Plus, companies get solid rebates tied to overall spend, money they'd lose if employees just used their own cards.
Rebates tied to consolidated corporate spend deliver a lot more value than an individual traveler reward. When spend is captured on a central card or virtual credit card program, the organization can negotiate materially higher rebate levels. They improve their cash flow and they get better data. So they get full visibility into trends, spend that drive better negotiations.
Michael Duffy, Vice President of Product and Innovation at Grasp Technologies, a provider of data management, reporting, and virtual payment solutions.
In contrast, the traveler, if they put the spend on their own personal card, their employer loses that visibility, that data coherence. It introduces friction in terms of reimbursement, and it's less meaningful financial value. It's not to say that the corporates are trying to take away points from travelers. They're just trying to maximize the return on spend for the enterprise, which is in orders of magnitude greater than the individual reward.
Nowadays, companies mix card products to manage trip expenses more effectively. Let's look at 3 types of cards that make up the backbone of corporate travel payments: lodge cards, individual corporate cards, and virtual cards. A lodge card, also known as a central or ghost card, is a static 16-digit number linked to a business travel account and shared across the entire department. Historically, the number was stored or lodged with a travel management company that serviced a particular organization. Today, it is integrated directly into an OBT along with all relevant rules and policies. An employee uses the OBT just like a regular travel website or app, but with very different search results. The corporate booking tool would prioritize partner suppliers that offer the best negotiated airfares and room rates. During booking, the OBT considers things like spending limits and job ranks. For example, a senior executive might get the green light to fly business class, while a junior employee sticks to economy. It's all about making sure that travel stays within budget and meets company standards.
Before I book an international flight, I do need approval from my manager, something like that. But built into the system, whatever tool that they're utilizing will actually send out for approval from that manager before you can book, as opposed to booking outside through a third party, whether that be directly with the airline or directly with the travel agency.
Once the reservation is approved, the OBT will use the lodge card number to initiate payment to the supplier. The transaction is processed via a card network, such as Visa or MasterCard. Unlike a personal card transaction that may show no more than the date of purchase, the merchant name, and amount paid, a lodge card captures granular details or Level 3 data. It includes the traveler's name, employee ID, department code, project or client code, and also data collected at the booking stage: ticket number, flight numbers, airport codes for departures and arrival cities, hotel check-in and check-out dates, or car rental contract numbers. The card issuer collects all transactions made with the lodge card and charges the business travel account at the end of a set billing cycle, typically weekly or monthly. The company then receives a consolidated, data-rich statement that offers valuable insights. For organizations, lodge cards significantly streamline accounting and reconciliation. The finance department can easily track major travel expenses without processing countless individual reports for flights and hotel stays. For employees, this payment method eliminates the financial burden of upfront costs for big-ticket items like flights and hotel stays. However, when it comes to on-trip expenses, lodge cards no longer apply. The most popular way out? An individual corporate card. Often called walking plastic, a corporate card is tied to an individual, not a department or project. It allows employees to cover meals, transportation, fuel, and unexpected expenses while on the go. Each traveler gets their own card, but it's still linked to the company's central credit line, allowing real-time tracking of all spending. The system automatically flags policy violations or suspicious transactions, and travel managers can adjust spending limits or block certain purchases. Like a lodge card, corporate cards make reporting and reconciliation easier by integrating transaction data directly into accounting and expense systems. They can technically collect Level 3 data, but not all point-of-sale terminals are equipped to do so. That's why the amount of detail varies depending on the tech environment capturing the transaction. The responsibility for paying the bill also varies. It's determined by the settings of the particular corporate credit card program. The most common model is corporate liability. The company receives a single, consolidated statement for all employee card spending and covers all expenses. Later, the traveler submits a report with receipts to ensure all purchases align with policies. Individual liability shifts financial responsibility from the organization to travelers. The card will still use a company's credit line. However, employees must pay the credit card bill from their own pockets, and then the company compensates them for approved trip-related purchases. Joint liability shares payment responsibility between the business and the employee. If a bill is unpaid, the card issuer can seek payment from either party. No matter the liability model, travelers still need to collect proof of purchase for finance teams, and that won't go away anytime soon. But with a corporate app that scans receipts on the go and sends them to the expense system, the whole process becomes easier, faster, and almost paperless. Typically, a company would use a combination of payment forms: lodge cards for large pre-trip purchases and corporate cards for on-trip expenses. Nowadays, both central and individual corporate cards may exist in a virtual form. A virtual credit card, or VCC, is a temporary card number generated for one specific purpose. You can set the exact amount, limit the merchants that can accept it, and give it an expiry window. All those controls mean much stronger protection against fraud and policy violations than a single static number shared among multiple people or multiple cards tied to a single account.
Virtual credit cards can be issued with parameters around them, and they'll actually decline if you try to use them outside of those parameters. Some of those parameters that can be adjusted would be the date, right? So that card is only available on this specific date for charging, which would be, the checkout date, for example, or the check-in date, the amount, right? So if I try to charge that card for $100.01, and that card is issued with a parameter of $100, that will decline.
A virtual card tackles fraud on two fronts. It safeguards the company's money and also shields employees from the headaches that come with a stolen or blocked card, like disrupted payments and travel delays.
Sometimes when we see clients who move away from the traditional corporate credit card to a virtual card, we see improved traveler experience. And what could be happening when they have a traditional corporate card is the traveler could be on a trip. The card gets compromised either through, the traveler's own trip. Sometimes those card numbers are shared amongst multiple trips, in which case, that impacts the traveler. They don't have an easy way to continue on their trip, whether it's buying meals, the hotel stay, any of that sort of thing. But because a virtual card eliminates that fraud risk, there's less of a chance of disruption to the traveler. So overall, better experience for the traveler.
One big perk of virtual cards is the rich data they capture. Just like lodge cards, and way more than regular corporate plastics, each single-use number can hold details like the traveler's name, supplier type, trip info, policy tags, even tax amounts. That means finance teams can reconcile expenses a whole lot faster. Sounds almost perfect, right? But the reality is that the VCC acceptance is not universal. Not all suppliers in every region are equipped to handle them. For instance, car rental companies worry that a VCC might expire before they can add any additional charges.
For instance, the traveler could incur charges from a toll, either a bridge, road, highway. The rental car company may not see that until a month or two later. There could be some sort of traffic violation that gets charged to the owner of the car, in which case, with a rental, it's the rental car company. And again, that may show up a month or two later. So the rental car company would like to have that card open for a longer period of time. And typically, virtual cards are only for the duration of that trip. So that's why there's some hesitation with rental car bookings. But however, in reality, that is less of a technical issue and more of a configuration to satisfy the rental car company. So I feel like that will change in the future, but currently today, that rental car companies don't broadly accept virtual cards.
So for now, companies can't run solely on virtual cards. They still need a mix of different payment methods, not just card-based ones. Here's another common setup. Instead of card payments, some suppliers just invoice the company directly. So, a traveler checks into a hotel or rents a car and pays nothing. The vendor bills the business later. It isn't perfect, but organizations can't move away from it just yet.
There's going to be markets that don't have mature systems that cater for lodge cards or virtual payments. So there is always going to be a need for a bill back or an invoicing capability with your TMC partner. But it should be the minority, because The challenges that come with invoice as your sole form of payment is you really lose control and absolute visibility on your program spend.
Instead, central card solutions and virtual payments are on the rise. Let's see what other trends will shape the future of corporate travel expenses. Experts agree that credit cards will continue to prevail in corporate travel, but not in their traditional form.
I think you're going to see definitely a more move to lack of a physical card, right? More physical cards are also not having a number printed on them any longer. I think that trend is going to continue. I don't see the credit card going away, specifically in travel and specifically in corporate travel in the near future, for sure.
At the same time, travel programs will adapt to a broader range of options, like China's super app Alipay, India's instant payment system UPI, different buy now, pay later platforms, and new global payment methods. And of course, AI is expected to be an integral part of expense management, helping to cope with growing data volumes and transaction diversity. A 2025 study by Serco and Sabre shows that over 90% of travel managers from U.S. companies with more than $50 million in revenue are already utilizing AI or Gen AI in their programs. 44% of the respondents believe it will have a significant impact over the next 5 years, while 22% say AI will reshape the entire industry.
Yeah, well, I think AI is going to continue to play a really big part. So it's, we already have it in the form of receipt scanning now, but it's actually taking it that one step further. It's about personalization. So it'll start to predict your travel habits, where you dine, where you stay. So again, predicting and starting to actually automate the reconciliation process for you, making you more efficient and productive while you're traveling.
To unlock AI's full potential, all systems in corporate travel need to connect and work together seamlessly.
There's something new in AI in the last year. It's called MCP. So that's Model Context Protocol. It's essentially an AI agent talking to another AI agent, and they're making connections themselves with underlying systems. And that's really going to change the travel world because everything, that might be a little bit broad, but everything is fragmented now. When these systems start talking to one another, it's going to make a lot more efficiencies, sharing of data, it'll help prevent fraud, and it's really going to improve the overall experience in the corporate travel world.
While AI agents are still a work in progress for the travel industry, virtual credit cards are already setting new standards in travel payments. To discover how VCCs work, watch this video next.